This is the Moneyweb Be a Better Investor podcast, picking the brains of professional investors on their investment strategies, successes, and mistakes. Your host, Reza Hendrickse.
Good day and welcome to the Be a Better Investor show, one of South Africa's longest running investment podcast, which is also available now on Moneyweb TV. My name is Reza Hendrickse, and in this show I speak to leading investment professionals about current market conditions, their portfolio strategies and their outlook for global markets. And the objective is quite simple: to extract some practical insights that can help retail investors make better investment decisions. My guest today is Reza Hendrickse. He is a portfolio manager at PPS Investments, and he has been in this role for nearly a decade. Reza, thank you so much for your time today. We are currently seeing a lot of unpredictable volatility, if I can call it that. And it's mostly as a result of a global conflict, this Strait of Hormuz, which is actually geographically very, very small, but very, very important in the world economy. And how do you find this environment? Especially if you are tasked with managing people's money to ensure that they retire comfortably.
Thanks, Rick. It's a pleasure to be here. And you're right. I mean, this year certainly has panned out to be something quite differently to what one would have expected coming into the year. If one just reflects back on last year, markets were extremely buoyant. SA equity did particularly well. So we go into the year with quite a constructive outlook. But then certainly things have been turned on its head now with the attack on Iran and what that might mean for the macroeconomy. So certainly I'm sure that listeners and viewers will be having a close eye on global developments and thinking, what should I actually be doing right now?
Well, most asset managers and portfolio managers will tell you, listen, don't take emotional decisions. You invest for the long term. Ignore the noise in the market, wait for signals, which is sound advice. But in practice, it's not always that easy. And even professional managers, they take decisions based on current events. So what is your experience currently about what professional investors are doing? Are they speculating? Are they greedy? Or are they turning defensive? What is your general view?
So, Rick, I mean, they teach you when you go to university that one should certainly have a focus on the long term. You should try and drown out the noise as much as you can. But ultimately, the long term is made up of a whole bunch of short terms at the end of the day. And so one does have an eye on the short term as well. It's important, though, just not to sort of overreact to short term developments. I would say that it seems as though professional investors have been approaching this whole current situation by sort of trying to look beyond it. And that certainly would have been the right way to play previous conflicts, where they tend to be short-lived. There's an initial sharp reaction, and then it's off to the races again. And so I would say professional investors have been trying to look beyond the current conflict, expecting it to be short-lived. Now, obviously, as we're already 2.5 months into it, and so it certainly has been anything but short-lived. And so it really begs the question now is when does one need to then start to react to what we're seeing?
Well, Donald Trump will be president until, I think, January 2029. That is, I would say 3 years ago, slightly less. That is pretty long term in the life of an investment manager.
It is a very long time, right? If one just thinks, so he was inaugurated at the start of 2025. And the widespread expectation at that point was that we'd see deregulation, we'd see some form of stimulus, tax cuts, etc. But we certainly haven't seen anything to the extent of what markets had expected. In fact, what we did see is we saw tariffs last year. We saw an increase in geopolitical risk. We saw sort of fears of recession and a growth slowdown. So already sort of early on in Donald Trump's presidency, we saw him starting to shake the tree a little bit. And so certainly in this year, we've really just upped the ante, and who knows what to expect over the rest of his term. Fortunately, unfortunately, it is the second term, and fingers crossed he won't be trying to sort of maneuver a third one.
Tell us about the PPS investment meetings. I'm sure there's a big team and you meet regularly to discuss markets, opportunities, risks, threats, Donald Trump. What is the general focus of those meetings? Do you try and Trump-proof the portfolios, or are you looking for opportunities?
So when we engage with managers, obviously there is quite a detailed macro update that one discusses. We talk about how the underlying managers' portfolios are positioned, how they're seeing the world, and then we get to understand just some more about the managers' thinking. So our job is certainly not to make a call on whether the managers' calls or stock picks are the right ones or not. Our job is really just to understand the various strategies in the portfolio, to make sure that when we combine those, that we end up with a diversified portfolio. And that really ends up being sort of our main focus, is ensuring that we fully understand the manager's strategy, that they are being true to their strategy, and certainly that then plays out in a sort of compelling performance signature as well.
Yeah, multi-managers, that's actually quite a niche, investment, what do you call it, investment strategy you can have for a firm like PPS. You invest in the funds of other fund managers. Your skill is to pick the best ones. Did the way you do that change over the past year, or maybe put differently, have you changed the names within your multi-management portfolio?
So we haven't made any significant changes, I would say, particularly over the year-to-date period. We've had a very close eye on global developments, and we've had close engagements with various managers as well. But it really just comes back to your question earlier around short term and sort of taking action based on short term developments. I would say that just reflecting on recent meetings that we've had, and recent as in the past 6 months, it's been interesting to see how managers have actually stayed quite constructive on the outlook for South Africa. They've been very pro-SA. They've sort of highlighted the fact that there's been improvements locally that hasn't always sort of met the eye. And so they have definitely pointed to a gradual improvement in SA. They've pointed to continued strong prospects for the SA equity market and SA asset classes more broadly. But coming back to your question of have we made any significant changes, we've added one strategy into the portfolio in the last 12 months into our SA equity portfolio. It's a manager by the name of Oyster Catcher, and it's a really compelling SA equity strategy. They also run hedge funds as well, and we're really excited about that particular strategy.
Do you discuss, or does asset allocation form a big focus of your strategy, or do you subcontract or delegate the asset allocation within portfolios to the fund managers?
So we run various portfolios, Rake. Some of those are specialist portfolios, specialist building block portfolios, such as our PPS equity fund, where we invest in underlying specialist equity strategies. But we also run multi-asset portfolios, where we combine those specialist building blocks. And in-house, what we then do is apply an asset allocation overlay. I'm part of the team I lead our asset allocation team, our tactical asset allocation team. And there we certainly do apply tactical asset allocation tilts based on valuations, bottom-up valuations, top-down macro, as well as a sentiment within that framework as well. And there we would then be sort of apply our view as to which asset classes are we more constructive of over the next 12 or so months, and then we sort of lean into those with value where we see the cycle turning. And so at the moment, just to give you some color on that front, we are overweight SA equities. We've been for quite some time now. We are also gently overweight global equities as well. And because we still think that the global cycle is supportive of that, although there is some caution as of late. But broadly speaking, within our tactical asset allocation framework, we are overweight growth assets.
Yeah, I think the South African narrative has been discussed at length. You know, the market has struggled for close to a decade, and over the last 2 years, we've seen some, I think good upside, well-deserved upside, where the valuations are a lot more realistic. But looking at the US market specifically, that market is directly impacted by Donald Trump, I think much more than any other one in the world. But their equities are at record highs. How do you explain it? Is that intuitive? How do you approach it now for future investments?
That's a great observation. I mean, who would have thought that almost 3 months into this war that the US equity market would be at all-time highs? It certainly seems as though equity markets in general have really just shrugged off what we are seeing out there. But I would say from a US equities perspective, it's also interesting just to sort of put that into context. So last year we went through a period where it seemed as though there was a kind of a move away from US equities. There was a broadening in investor appetite. We saw emerging markets do well. Ex-US equities also did very well. The dollar was weakened quite significantly. So that whole cycle seemed to be against US equities. Now, 2026, we've come into this year. There's been a narrowing of equity market performance once again. US, as you mentioned, is at all-time highs. And so the question is that justified? If one looks at the earnings performance of the big companies in the US equity index, those companies have really been coming through with strong earnings. And so I would say it is justified that the US equity market is doing well. We've also seen the dollar sort of strengthen once again, that also tends to sort of align with that as well. And so the caution ultimately would then rest on the valuation side. And there, 100% agree with you that the US equities are looking quite expensive on a long-term basis. But I would say the big driver of the strength of the US market has been continued strong earnings performance, particularly from those tech companies.
But it's only the big Magnificent Seven. I've seen your global equity portfolio is maybe overweight Magnificent Seven. Most of the names appear in the top holdings of that fund. Many of the other sectors have not performed as well. So definitely the US market is very, very concentrated. Is that a risk, or is just a function of the excellent performance of those companies?
It is a risk, Rick, that there is such concentration, because not only is the US equity market concentrated, but the global equity index is quite concentrated as well, because the US makes up quite a big part of the global equity index. It's around 2/3 of the MSCI ACWI. So if one looks at our global equity fund, that fund is sub-advised to Capital Group. It's one of the largest active managers in the world. And that portfolio does have a significant amount of US equities and Magnificent Seven. What you'll also note is that they are in fact underweight the US, roughly 10% underweight the US and overweight the rest of the world. So the manager is expressing a view there. They are underweight that expensive region, but they have selected those companies where they believe that they do still have a runway.
What are your views on other geographies? Where do you see opportunities? China, perhaps?
So we leave the regional call up to the global equity managers themselves. And so there we take the lead from those underlying global equity managers that we select. We don't tilt into regions specifically, but I would say there certainly does seem to be opportunity elsewhere. Last year, it felt as though we were at a turning point where places like Europe were going to come back into vogue. We saw economic stimulus, fiscal stimulus from key regions like Germany, a big focus on defense spending, etc. It seemed as though there might just be an economic revival sort of building. That seems to have fizzled out, unfortunately. But emerging markets, having said that, there still seems to be some opportunities and good prospects there. This year, the parts of EM that have done well have been those companies like Taiwan, Korea as well. Those economies, stock markets geared towards AI and technology, etc. They've really done well. So even though SA is sort of barely positive, other parts of the EM complex have certainly been quite strong. And that comes back to your point of China. China is certainly also poised, I think, to benefit from that continued good performance of EM. But really, I would say SA is the market we're most excited about, just if one looks at the globe. I know we're quite small, but we do think that SA prospects are actually looking quite good.
Yet, we have, in many ways, the same problem as the US market. Our performance over the last year or slightly longer has been dominated by commodities, especially gold. So we did see a very, very positive performance, but a concentrated performance. Does that worry you?
You're 100% right. So last year, it was very much a precious metals driven market. Half of the market's 40% gain came from precious metals. So, and there certainly was some concentration. It started off with gold being the key precious metal. It then sort of moved on to include PGMs as well. So the question now ultimately is will that continue? Will we see other parts of the market doing well? The view early on in the year was that things like financials would start to do better. There's good value within the financials, our banks in particular. They seemed well placed to continue to sort of take over the baton and then start to do well. That unfortunately, because they're more economically sensitive and because the rates outlook has shifted, that view has changed. But I would say there is still an opportunity. This year, we've seen energy do quite well, for example. The outlook for gold and precious metals is still quite strong. We might not see that sort of 100-200% rises from these companies, but we're still likely to see good gains based on the fact that the outlook for precious metals is still quite good. But the outlook for other sort of industrial metals, copper, etc., all of these companies sort of linked to the energy transition, sort of there's good prospects there from the broader commodity complex. But other things like financials, etc., also still looking quite attractively priced.
Just lastly, what would your advice be to young investors who have opened their Easy Equities account? They put away their 500 Rand a month or 1,000 Rand, and they would like to get skin in the game, invest in financial markets, build wealth, hopefully generational wealth. But it's not easy to do. Even the experts really battle to be correct more often than not. What would your advice be to those individuals, given this current uncertainty, a lot of noise? How would you advise them?
Rick, I would advise them to have broad exposure. That would be the one piece of advice, is to sort of invest broadly. And so there, sort of exposure to either a unit trust or an ETF or something where you can get access to a broad range of equities. That would be the first piece of that. And the second piece would be, don't chase last year's winners. We saw that, how quickly things can change. And so focusing instead on sort of the long term, as we mentioned earlier, starting valuations. And there we think that starting valuations in SA are quite constructive. I'd say have a significant amount in SA equities. If you are a young investor, you're probably looking for the next 10 odd years. And based on where we starting valuations are in SA, it certainly looks as though the medium to long term returns are going to be better here than what one will get offshore. So over the past 5-10 years, 5 years, but 10 years, global equities certainly were the place to be. The next 10 years, SA equities have got a much better chance of doing well. So we'd say broad exposure, which is the diversification argument. The second one is don't chase last year's winners.
I always get the question, what is a good return? And I'm talking specifically in the context of a young investor. they want to measure themselves against the professionals. So should they look at the JSE All Share Index? How should they measure their performance?
That would be a fair index if one has got a pure equity portfolio. I think we all want as much as we can, as soon as we can, and that ultimately can often actually lead to sort of making poor decisions. But I would say for an equity-heavy portfolio, having an eye on the JSE, that is a very good benchmark to have. One can also, if one is saving for retirement, you're quite likely to have a Reg 28 type investment solution where it's a balanced portfolio, a mix of equities, bonds, etc. And there, kind of inflation plus 5 tends to be a popular benchmark. But you can also look at the category average of the multi-asset high equity, the ASISA multi-asset high equity category. So there's a couple of benchmarks one can look at. The most popular one would be the JSE. And there these days, it's capped all share index is the key benchmark that managers look at.
I think if you can beat the JSE All Share, you've really done well. Many professional investors struggle to do that consistently. Reza, we'll have to leave it there. Thank you so much for your time and for sharing your insights with us.
Thank you, Rick. It's been a pleasure.
That was Reza Hendrickse. He's a portfolio manager at PPS Investments.
That was the Moneyweb Be a Better Investor podcast with Rake van Niekerk. Thanks for listening. Catch up and listen to all the Moneyweb podcasts on moneyweb.co.za or the app. Moneyweb, your trusted source for business and investment insights.